All right. In this discussion, we intend to talk about the important topic of the psychology of trend formation and its classification. Okay, let me open this slide. As you can see, it's about the psychology of trend formation and its classification. Before we talk about it, there is a very, very important topic that I need to present to you, dear ones. That is the discussion of market psychology, yeah, and the analysis of emotional behaviors is very, very important and carries a lot of weight. That means there are times when you analyze a stock, you implement all the technical methods on it, but you must have a good understanding of the psychology of trend formation. So, what important topic is this psychology of trend formation supposed to present to us? You see, Mr. Dow, in the stages of trend formation, came and said that one, we assume the market has a trend, or as they say in Latin books, the market is trendness, meaning the presence of trends in the market. In fact, in upward and downward trends, it requires the formation of stages. Mr. Dow says that in an upward trend, meaning for an upward trend to form, we must go through three stages. The first stage is the accumulation stage. This means when very, very bad news is spreading in the market. However, the heavy declines are coming to an end and the professionals are busy buying. This is very important, guys. Look at what we have here. In this slide, I want to teach you how to move against the flow of a river, and this is very important. There was a time when our stock market was in a very, very negative and difficult condition. But always remember, a negative market does not actually mean a less attractive market. For us professionals, what happens in the market in reverse is always important. That is when a market is very green and excellent. If you have noticed, most beginners in the market like this kind of market. What a good market, right? An excellent market is positive every day, but professionals are worried about this market always. They always move against the flow or in reverse. Consider a negative market. Today, for example, the overall stock index has significantly decreased. The market is negative, all the stocks are in the red. And what a bad market it is. What a market, I don't know. We won't even go near this market anymore. No, yeah, this news cannot be true. For a market professional, professionals like that negative market. Why? Because they say this negative market is a very good opportunity to re-enter any Tamikai market and buy stocks. So always keep in mind, the first stage of forming an upward trend is when we still don't have an upward trend. The stock's price chart has a downward trend, but there's still bad economic news in the market. Everyone is complaining, everyone is upset, but the heavy falls in the market are ending. And we are slowly feeling that something is happening. The stock is still negative, but something is happening. Something is happening that professionals are slowly starting to buy. We call this stage the accumulation phase, and when the accumulation phase ends, the second stage is the phase of sustainable growth. In this stage, pay attention to my slide. What I wrote is that in this stage, often beginners are disappointed with the market. That means beginners are still disappointed with the market. And many of them have exited the market. They said, this stock is really bad. Let's sell it at a loss so we don't incur more losses. I left the stock with disappointment. The market has a favorable growth, but it is steady and calm. Usually the news in these circumstances continues to be pessimistic, and many predict a renewed recession. Many are afraid that it might drop again. This stage is the stage of stable growth. But the third stage, where the market explosion occurs, a massive explosion happens in the market. It is a stage where purchases become emotional and very irrational. And when a professional investor asks themselves, when is the right time to sell a stock? For me, it's when a novice finds the stock so attractive that it has already grown well, grown significantly, and I am happy to join the queue to buy this stock. But a professional never likes a stock that, for example, has been positive for 40 days and continues to take an upward trend. That professional does not like this stock. They are looking to sell this stock. So, we must pay attention to these three stages in the formation of an upward trend. Well, considering the previous three stages of forming an upward trend, Mr. Dao Chi has actually categorized trends into different classifications. He says that we have a series of trends called primary trends. This is also very important, guys, so that later we can become familiar with the charts on the graph. Know these terms well, so that we can work with them on the software later. We have a series of premier trends, or actually primary trends. These are trends that investors usually observe in the long term, and their studies are long term on these trends. We call these primary trends. Primary trends in the science of technical analysis and in the capital market can last between 2 to 4 years and show the main market fluctuations slowly and steadily. However, within these long-term trends, we have a series of shorter trends. They say they are more prone to stumbling, meaning secondary trends. They are subsidiary trends. In terms of terminology, secondary trends act as a series of rest stops that occur against the market direction. What does that mean? It means, kids, imagine there is a long positive trend. Within it, there is a small negative trend. Then again, a large positive trend. Within it, there is a small negative trend. These small negative trends, or conversely, we have a long-term downward trend. Yeah. Within it, there is a small upward trend and a long-term downward trend. Within it, there is a small upward trend. These trends that usually go against the direction of our main trend, the long-term trend, which is called the main trend, arise against this trend. These are called secondary or minor trends. And these last about 6 weeks to 6 months, approximately 3 weeks, I apologize, to 6 months. We call these trends short term, so pay attention. In the science of technical analysis, 3 weeks is the shortest time for you to hold a stock. The shortest holding period is the stock. I probably see a lot of my friends as analysts. I am even an analyst, but they come and buy a stock based on excitement in an emotional manner. And they want to sell it 3 days later. They want to sell it 2 days later. Pay attention. The stock you buy needs at least to be in a short-term trend for 3 weeks. That means you should not sell the stock in less than 20 days. And selling the stock in less than 20 days means your behavior is impulsive. When you buy an asset or make an investment, you need to allow it to generate its profit. You need to give it time, and time is a very important factor. So our secondary trends. The secondary one lasts about 3 weeks to 6 months. We, so to speak, refer to this. When we see a small downward trend within an upward trend, we call this, so to speak, a resting place. We say it's a refueling. It's as if the chart wants to take a break, refuel again, then continue its trend with strength again. So these small trends are not indicative of a market crash, or small positive trends within downward trends are not indicative of market growth. These are merely a series of resting places where the chart, after resting, wants to continue its trend with more strength. Mr. Da also mentioned a third category regarding small trends. There are some trends that are very small trends, exist, and we do not consider them. Note that in the science of technical analysis of volatility are seen as noise. And in fact, Mr. Da's theory does not value them. So, in these three categories that I mentioned to you, dear ones, the first two categories, namely primary and secondary or minor trends, are among those trends that we must use in our analysis. Now, and the third category would be less, which are minor trends, we avoid and do not use.